I think coming back to your being indeed doo-doo, which I think should be a new economist term, technical term. The UK, for example, its currency has devalued by 20% since 2008, yet its trade deficit is the largest it's been since the 1940s, and that's because we don't actually produce anything that anybody wants to buy anymore, And so that return, I think it's almost the opposite here in the UK, where the state is retrenching, the service industry is falling apart, and there's a vacuum. And what we're finding is the social economy is beginning to kind of fill those gaps. And you're finding that social enterprises and charities are the ones that are really, really being innovative and using new public service models, new trading models, and they're the ones that have, if you look at surveys, they're most confident. They're the ones that are employing most people. They're the ones that are growing more, rather than the general SME market. So, we believe that there's a real market there that can grow in the UK, which needs financing, but it needs a different kind of financing. And that's where it needs more places to go to get access to capital that is congruent with what they're trying to do, that gets that this is a long-term play rather than short-term profit maximising play. And that's why we invest in the intermediaries. That's what they're there for, to grow that market. The innovation, I think one of the temptations is to focus on the financial engineering bit separately from actually what that actually delivers. And the financial engineering is only as good as the fundamental, the underlying value, both social and financial, that it can deliver. And I think there's sometimes a bit of a danger of separating those two things. So we're trying to kind of make sure that those two things are yoked together, really, that the social, financial, and the financing is really completely yoked together. The innovations that we see, I would say the two really interesting things that we're seeing, or three, are the ever-famous social impact bonds, which, actually what they're interesting is because they have beneficiaries, service providers, investors, performance managers, and government or commissioners, procurement, all in one structure, and they have to get along and they have to agree on actually what the purpose of this whole thing is for the longer term. And that's been quite interesting to get that much more confluent stakeholder group together in terms of financing for social change. The other thing that we're beginning to see a lot of is retail, actually. Retail people get this, in some ways, way, way better than institutions. So how can we, there's a survey done by Standard Life Investments that said 77% of people in the UK would want to buy a social investment fund as part of their pension. 48% would look for an environmental and sustainable fund. They get it. So again, we're trying to create the product in the middle that will allow not just the high net worth, who are very important, but actually the ordinary retail investors to be able to engage through their pension, through their savings accounts, through their ISAs. So I think those are the two interesting things that are beginning to happen.